bond market sits at the heart of the economy, and understanding how it works is fundamental if you want to understand how money and our economic system works. Here we'll break down exactly what you need to know about bonds, how the market for them operates, and how they affect everything in the economy, from the performance of the stock market to the cost of mortgages. So, what is a bond? A bond is simply a contract between two parties, where one party agrees to lend money to the other for a period of time, in return for some interest. A typical bond will look something like this. Let's imagine a local bakery that's doing well and wants to expand, but they need to borrow some money to do this. What they could do is create a bond, which is essentially a certificate that says, I promise to pay the bondholder £100 in exactly 10 years' time, as well as £5 per year for the next 10 years. Now, if the bakery is reputable and people believe that they'll honour this contract, then they'll be able to sell this bond to an investor who's looking for somewhere to put their money in return for some interest. So let's say that one of the bakery's customers walks in one day and says, I've got some cash lying around, I'll buy this bond. Now in this situation, the bakery is known as the borrower or issuer of the bond, as they're the ones who've created and issued the bond and borrowed the money. And the customer who's bought the bond is known as the investor or the bondholder. And because the bond pays £100 in 10 years' time, we say that the bond has a face value of £100 and a maturity of 10 years. And the £5 interest paid each year is known as the coupon, and it's usually expressed as a percentage, so it would be a 5% coupon, as it's 5% of the face value of the bond. But the actual price of the bond, i.e. how much the investor initially pays and how much the borrower initially receives, isn't fixed, and will depend on other factors within the economy. Think of it like this. The bond promises to pay £5 each year and then £100 at the end of 10 years. If the customer were to pay exactly £100 for this bond, then their effective interest rate or rate of return over this period would be exactly 5%. But what if the investor could just put their money into a normal bank account and get, say, a 6% interest rate? In this situation, there's no way that anyone would choose to invest in the bakery's bond, as it's not competitive. Investors can go elsewhere and get a better rate of return for the same level of risk. So if the bakery wants to sell this bond, they need to make it more competitive by increasing its rate of return. And they can do this by lowering its initial price. Imagine the bakery says to the customer, okay, the bond still has a 5% coupon and a face value of £100, but we'll let you buy it for just £90. If we do the maths, the bond now has an effective interest rate of 6.65%. And the customer's now getting a much better deal, and the bond has become more attractive. But on the other hand, it's become more expensive for the bakery to borrow money, as they're only getting £90 to begin with, but will still have to pay £5 in interest per year, and then £100 at the end of 10 years. And it's this effective interest rate, or yield of the bond as it's known, which is the most important metric that investors look at, as it essentially shows the overall rate of return that investors will get if they invest in this bond and hold it to maturity. And as we've seen in our example, the bond's yield is inversely proportional to the bond's price. If the price of the bond drops, then the yield will go up, but if the price of the bond increases, then the yields will drop. Higher yields are better for the investors, as they get a higher rate of return, but lower yields are better for the borrowers, as they get to borrow money more cheaply. So that's basically all you need to know about bonds in general, but bonds don't just exist in narrow examples like a bakery looking to expand. The core of the bond market, and the piece that sits at the heart of the economy, is the market for government bonds. Now, government bonds are the same as any other type of bond, only the issuer is a government rather than a business or an individual person, and they're the main way that governments around the world will borrow money. But why do governments need to borrow money in the first place? Well, as you might know, most governments will spend more money than they collect in tax revenues in a given year. For example, in 2024, the UK government spent £1,279 billion on everything from healthcare to social security to fixing potholes, but they only collected a total of £1,141 billion in taxes. So if we do one minus the other, we're left with a £137 billion shortfall, which is known as the budget deficit. And the government will need to find this money from somewhere in order to pay their bills. And they'll have to do this through borrowing money, which they'll do by issuing thousands and thousands of government bonds. And governments have done this for many years. Basically, since the end of the war, most governments around the world have run budget deficits way more often than they've run budget surpluses, which has led to the accumulation of huge amounts of debt. In the UK, our debt pile currently sits at around £2.8 trillion, which means that if we gather up all of the UK government bonds which currently exist, their combined face value would be around £2.8 trillion. And as you can imagine, this debt pile consists of billions and billions of individual government bonds, which might have face values of just £100 or £1,000 each. And each of these bonds will have been issued at different points in the past, and they'll all have different lengths of maturity. So it's as if the government has a conveyor belt of bonds which are constantly maturing on a daily basis. Today we might have £50 million worth of bonds which are maturing and need to be paid back. Tomorrow we might have 100 million, and so on and so on. And as we mentioned before, the government already spends more than they collect in tax revenue. So it's not as if they've got a big pot of money sat waiting to pay off these bonds as they mature. So what they need to do is they need to issue new bonds to repay and then replace the existing bonds, in a process known as rolling over the debt. So in any given month, the UK government has to raise billions or tens of billions of pounds by issuing new bonds in order to meet their spending commitments. And if they don't, then they might not be able to pay their day-to-day bills, which would be very, very bad for the country. Okay, so we've looked at why governments need to borrow money, but why would anyone be interested in buying these government bonds in the first place? Well, if you're an investor or just someone that has some money lying around, buying government bonds can actually be a really attractive opportunity. Firstly, because they're incredibly low risk. In fact, bonds issued by countries like the UK, the US or Germany are seen as some of the safest investments in the world and are much safer than just keeping a load of cash in a bank account. Think the only way that investors won't get their money back is if these countries default on their debt payments, which basically never happens, and governments will try to avoid this happening at all costs. And secondly, it provides the opportunity for investors to lock in a fixed rate of return over a set period of time, which can be really useful from a visibility standpoint. So it's this combination of security and certainty that makes investing in government bonds attractive to businesses and other institutions like pension funds, wealth managers, and even foreign governments. Okay, so we've got our market set up and know why governments need to issue bonds and why investors want to buy them. But things get interesting when we start to look at the power dynamics that exist within this market and how changes in bond yields can ripple through the entire economy. So as we've mentioned, governments around the world have massive piles of debt that have accumulated over the years, and many still run budget deficits to this day, which is adding to this debt pile. And because of this, they absolutely have to raise billions and billions on a weekly basis through issuing new bonds in order to meet their day-to-day spending commitments. So the government really doesn't have a choice. There's no other way it can raise this kind of money in such a short space of time. So they just have to accept whatever price the bond market quotes them. And because we're talking about such huge sums of money here, things can start to get really expensive for governments if bond yields start to increase. Remember, if bond yields increase, then it becomes more expensive for the borrower. This then makes governments incredibly vulnerable to increases in bond yields. Even just a few tenths of a percentage increase can raise borrowing costs by tens of billions, which inevitably has to be paid by us, the taxpayer. So in order to fight against this, governments will typically try and present themselves as financially sensible in order to signal to the bond markets that their bonds are some of the safest in the world, as this will hopefully boost demand and keep bond yields as low as they possibly can be. And this is exactly the reason why someone like Rachel Reeves in the UK is so obsessed with keeping her fiscal rules unbroken, as it's a strong signal to the bond market that the UK is being sensible with its borrowing, which will hopefully keep the yields as low as they possibly can be. But it's not just borrowing costs of governments which are affected by changing bond yields. The effects will ripple through the entire economy and might affect you personally in a number of different ways. So if you sat there thinking, fine, that stuff about government borrowing costs is interesting, but how does this all affect me? Well, first of all, bond yields have a direct effect on the performance of the stock market, which if you've got a pension or any money invested, then this will be of interest. As we've mentioned, the yields on government bonds can basically be seen as a certain rate of return, and investors will view this rate as the risk-free rate that exists within an economy. So if the yields on government bonds goes up really high, say to 6 or 7%, then investors will start to look at the stock market and think, do I really want to be invested in risky stocks, which is an average return of around 8%, but which is by no means certain, when I could just take my money out of the stock market and put it into government bonds and lock in a certain 7%. So in situations where yields on government bonds are high, then investing in the stock market becomes less attractive, and a lot of people will sell their holdings to instead buy bonds, which can put a good amount of downwards pressure on the stock market. However, the opposite is also true. When yields are low, investor demand for stocks will rise, especially if bond yields are below the level of inflation, as in this situation, the real returns on bonds will actually be negative, therefore pushing investors into alternatives like the stock market even more. But it's not just the stock market that bond yields will affect. In fact, they set the benchmark for any type of borrowing within the economy. Think, if you're a bank and you know that you can lock in, say, a 4% risk-free yield on a government bond, then if you were to lend money to anyone else, whether that be a business or a first-time buyer looking for a mortgage, then you're going to demand at least a 4% interest on any loans that you make. So if bond yields within an economy picks up for whatever reason, then it can start to slow everything else down in the economy, because all types of borrowing becomes more expensive as interest rates on things like business loans and mortgages increases. And this is why we say that the bond market sits at the heart of our economy and financial system, as it acts as the benchmark from which all other types of borrowing and investing follows. If you found this interesting, please drop me a like and subscribe to the channel for more. Thanks for watching.